I would like to welcome you again to another QuantInsti webinar. And today we have a session that is an algo trading project webinar session. So this session has two project presentations by our esteemed EPAT alumni. So first it will be on implementing pricing model using Kalman filtering adapted to market regimes by Evgeny Tishkin. And the second one is on dynamic asset allocation using neural networks by Mrinal Mahajan. So let's just dive into the project one. All right. But before I start off with the introduction of our first speaker, I would like to request everyone to put in all of your questions in the questions panel during the presentation. We will pick all the questions, at least as many as possible, at the end of each presentation. All right. So the first presentation, now this is going to be presented by Evgeny Tishkin. So Evgeny is a senior quantitative analyst from Russia. About Evgeny, he has more than 10 years of experience in various algorithmic trading and HFT firms as a quantitative developer, chief software architect, quantitative analyst, chief technical officers. He has created a complete low latency multi-exchange algorithmic trading infrastructure and high frequency trading framework from scratch as a CTO for one of the algo trading hedge funds. And a few things about him. Adding to that, I think he has also won a second place among more than 4,000 quantitative researchers from 100 countries around the world in XPX Markets Global Forecasting Channel in 2019. He holds master's degree in computer science from Samara State Aerospace University, and he has also a specialty in machine learning and data analysis from Moscow Physical Technical Institute. And last thing, I mean, obviously, he has also completed the EPAT program by QuantInsti, and he is also a fellow EPAT. So I will make Evgeny the presenter. Hello, Evgeny, are you here with us?
Yes, I can hear well.
Okay, you can share your screen now, and probably you can turn on your camera as well. We can see your screen.
Okay, Shitish, thanks a lot for introduction. So my name is Evgeny, and I will tell you about my EPAT project. So this project was aimed to share some educational example about how to use quantitative techniques of online machine learning in trading strategies development. So online learning allows for deeper automation and of algorithmic trading in comparison with traditional regular model retraining with subsequent cross-validation. This is because such models can adapt their parameters on the fly while being used in real-time trading simultaneously. So we have two parts which work simultaneously: it's trading and training. In real production, strategies are far more Nevertheless, incorporated online models, which I will tell you about, have universal application, could be applied to different kinds of trading strategies, from passive investing to high-frequency trading. So, what is the idea behind? What is the idea behind the project is creative strategy, quantitative strategy that improve just simple sector investing. I chose the big tech of USA stock market as example, and took FNGM stocks, most popular stocks: Facebook, Apple, Netflix, Google, Amazon, and Microsoft. and I took publicly available end of the day close prices from the crisis of 2008 till March, till, as far as I remember, March of 2021, the current year. And I performed the following steps. I calculate simple buy and hold, tried to rebalance it every month in equal parts. It means that equal part for each stock, and try to improve baseline, this baseline using some online pricing models I experienced with online linear regression, online principal component analysis, Kalman filter, and also tried to filter out market regime using hidden market models to improve the performance of built models. So I will tell you about my trading approach. This is not simple to understand, but not very difficult. So what is the approach? So the approach is aimed to reduce the risk of buy and hold. Buy and hold baseline strategy. The approach is based on statistical arbitrage techniques for picking up entries and exit to, I would underline this, to only long only positions. So we compare buy and hold with long only active trading. I use online day-by-day calculations to determine undervalued, overvalued prices, overvalued states of stock relatively to other similar stocks in the sector. So the key point is relative value of the stock. How I calculate it? I calculate it as real price minus predicted price from some model, which based on other prices, other stock prices in the sector. This way I calculate residual is a real value minus predicted value, and I will buy the stock on local lows of its value and sell on local highs. So I use residuals, so-called residuals. Residuals are calculated using the model I have mentioned above. So using linear regression, PCA, and Kalman filter. So inputs as inputs for models, I use just simple stock price deltas, and look back rolling window for online learning was 1 year, so 252 days. Let's talk about the models behind. So online linear regression. So this model is used for pricing model price of the stock, which is used to calculate fair price and then calculate residuals. So what is online regression? Online means that we train model each day and take data for training with some look back period from the data set. Linear regression assumes a linear approach for modeling the relationship between target and explanatory variables. So in our case, I use linear regression to find optimal coefficients for the statistical linear spread between correlated stocks of the sector. So before applying this method, I made sure all stocks in our portfolio are highly correlated with each other with a Pearson coefficient above 0.9. So based on these results of everyday training, I calculated residuals, which I then will use according to my trading approach. So what concerns online principal component analysis? Principal component analysis is approach based on eigenvalues and eigenvectors of the matrix. It is used for solving different problems in data analysis by extraction of orthonormal non-correlated components of variance. And I use it in the way you can read it in the resource from Dr. Tom Starke from EPAT. It's a very interesting resource, how he used it in multiple statistical arbitrage. So I used a similar approach, but I use it online. So I retrain the model every day. And I use one or two components of variance and use them as factors of features to model, to online model, also linear regression, online linear regression, which I described above. Another model, interesting model, adaptive, is Kalman filter. It is similar to online regression. So it's also I also use price and delta as inputs. It's a well-known algorithm in statistics and control theory that use time series measurements for producing more accurate estimates of target variables. I use the Kalman filter for evaluating coefficients of online regression, which explain target stock prices by independent variables, others, which are other stock prices from portfolio. Similar approach described in a great book of Dr. Evgeny Tishkin, Algorithmic Trading, Winning Strategies and Rational. I highly recommend to read this book. It's very useful and could be useful in your work as a quant, as a quantitative analyst, and anyway, in Algo Trading. And it is very similar to online linear regression approach. Incorporate statistical spread coefficients, but do not use look-back period, look-back rolling window. Instead of this period, the Kalman feature is parameterized by delta parameter, which influences the adaptiveness of the filter. So, and also another model which I use, so I will tell you about. It's high hidden Markov models. The model is based on Markov process. Markov chains assumes that there is another process, Y, with observable variables, stock prices, for example, which depends on current Markov process with hidden states, so-called market regimes. I consider as market regime, for example, uptrend, downtrend, volatile market congestion, and whatever, as a hidden market state, which could be characterized with set of parameter distribution, visible distribution with specific parameters determined by optimization. So visible parameters are some parameters which are extracted from current market state. So what for these parameters, I use price delta for Nasdaq 100 ETF and VIX, so volatility index. As inputs, as visible market indicators for hidden market model. The trick was I clusterize some states, use this model, and I pick up some states with average price return, future price return above 0, and in these states I didn't perform exits. So I increased time in potentially profitable positions via adaptive market regime detection. So that was a trick. So let's go to the results. What I want to comment. So the approach applied just very simple to beat the market buy and hold strategy in terms of total profit. It's used just doesn't use anything but simple end of the day close and deltas of this close. However, I have managed to overcome buy and hold strategy risk. So you can see risk measures as mark, drawdown, sharp, and Kalman by using multiple entries and exits determined by online relative price techniques. So key takeaways are, so stocks relative pricing could be used for determine entries and exits price points. The price for these entries and exits point selection. For relative price, we could take prices of other correlated instruments, for example, stocks of the same sector. Residual from fair price, a suitable measure for overvalue and undervalue states of concrete stock. And online machine learning helps to build automated real-time pricing model. So I understand that it's not 20 minutes, it's not enough to share you all details about this project. But you can see my project on QuantInsti.com, and even also you can download my code. And also feel free to contact me using LinkedIn. And also, sure, if you have any question, you can ask them now.
Thank you, Evgeny, for sharing your project work with everyone. To our entire audience, I would request, please ask all your questions in the questions panel now. We already have received a few. So for those of you who are asking whether this webinar is going to be recorded or the presentation that you are seeing here will be available, yes, the webinar will be recorded and will be available on our YouTube channel, as well as the entire presentation file along with all the links will be available on the same as well. All right. So okay, so let's start off with the first question that we have received. Now, Manogan asks, so yeah, Evgeny, can you hear me?
Yes, I can hear, but I tried to extract the question.
Yeah. So I'm going to ask you the questions. I'll be pick them one by one. All right. So you can simply answer them. So the first question is, do you still participate in algo trading competitions, or are you at a point in your career where this is no longer interesting or beneficial? So do you still participate in algo trading competition?
Not yet, because I have not yet do not have time enough to do this, and I heavily involved in algorithmic trading production and making models and other stuff. But I would recommend it to anywhere who want to improve the experience in this, because it's very helpful, and from my experience I found it very useful for me.
Thank you for sharing that. I hope that answers your question, Manogan. The next question is by 𝗿𝗲𝘀𝗀𝗃𝗃. So the question is, thank you for your presentation. And are these backtesting results or the results of actual trading? So is this just backtesting, or is it the result of actual trading?
No. This is just I see question. So this is just educational example. So this is just backtesting results based on close pricing, but it's verified. It's not results from real trading. So this wasn't the purpose of the project.
Okay. Okay, so this is just simple backtesting result. All right, moving to the next question. So next question is by Bruno Prianti. So he asked, so he's saying, I appreciate your work. Could you explain more about the use of linear regression for optimal correlation with target VAR?
Okay, so let's move to trading approach slide. So, in fact, what was inputs for linear regression model and other models? It's deltas, so price returns. So it's price returns of other stocks in sector. So we have target stock, which we want to predict, return of which we want to predict, and other stocks. So inputs for regression was just price deltas for other stocks. So all the details you can find in my EPAT project, because it's not simple as I now described. And linear regression is used to find the coefficients which linking target variable with explanatory. So it's quite simple procedure, but it was repeated every day. So for online learning with a rolling look-back period. So the data wasn't used all data for all years, but just for last year rolling.
Okay, I hope that answers your question, Bruno. The next question is by Barry. So Barry, classmate, asks, on slide 9, B&H strategy seems to work the best. Why didn't the quant strategy work?
So could you repeat, please?
On slide 9, slide number 9, B&H strategy seems to work the best. Why didn't the quant strategy work?
Do not still understand the question. Could you send me this on chat?
Sure. So if you go to the questions panel, can you see in the question panel? You can.
Yes.
Yeah. There is a question. Yeah, there are a lot of questions. Yes. There is a question. I going to assign it.
In fact, too small window. I think it's better if you just send me this question as message.
Sure. I just send this question. Just a second. Okay, I just shared it over chat.
So yes, thank you for the question. Buy and hold strategy seems works the best. Yes, it works the best in terms of total profit, but you do have you can see that drawdown for this max drawdown for this strategy is 50%. So that means that you can lose 50% of your capital investing in this. And the aim of the project was beat the risk. So beat to struggle with risk. So risk-adjusted return is higher for optimized strategy. So that was the goal. So, and why didn't the quant strategies work? Because they don't trade all the time as buy and hold. They are not all time in a market. So they pick up the times which have probability shift to open the position with profit. So I hope I answered.
Yeah. Yes. Moving to the next question. Now, I'll also ping that question in the chat for you. So, Nikhilesh asks, what are the hidden states under this statistical model in your project for which we are using the hidden Markov model?
Yes, I see. What concerns hidden states, I chose, as far as I remember, 2 or 3 states, means market regimes, which were calculated by parameters which I mentioned. It was price deltas for sector ETF and VIX deltas as observable market indicators.
Okay. I hope that answers your question, Nikhilesh. The next question is by Stefan. Stefan asks, what features have you used in your analysis?
So I use very, very simple features. It's price deltas, but deltas themselves not just deltas with previous tick, previous day. Delta between the price and their moving average. I use months period for moving average. So that was all features based on deltas, simple delta, simple features. And what concerns principal component analysis, I extracted first and second components from these deltas and use them as features to line regression.
Okay. Okay, so I hope that answers your question, Stefan. The next question is by a user with just two short form VP. So he asks, did you have any strategy about how many principal components to select for the PCA model?
The strategy is very simple. In fact, my opinion is we want to see the first and at least component, but probably we could pick up second component also. So 1 or 2 first components, they explain most of variance, especially when we talk about the sector. So if we talk about the wide market, so I think we could pick up more. But in this scope, we have deal with only with stocks from the same sector. So I think 1 or 2 enough. So I used, as far as I remember, I used 2 components.
Okay, all right. Thanks for that answer. The next question that I have here with me is by, again, 𝗿𝗲𝘀𝗀𝗃𝗃. He asks, why did you decide to predict price rather than volatility?
Predict price instead of what?
Instead of volatility.
Okay, so thank you for the question. So prediction of volatility is another area to explore. So it's out of scope of this project. This project was just try to improve buy and hold using multiple entries and exits to improve in terms of risk. And that's why we try to predict the price, not volatility. But when I experimented with the market regimes, so I pick up features for market regimes for hidden market models as price deltas for Nasdaq 100 and VIX. So volatility is also considered when modeling. So in this case, for determined market regimes, volatility is also predicted. So not predicted, but used for determined market regime.
Okay. Okay. So there are so many questions that are keeping coming, but we are short on time. So it's time to move on to our next presentation. But before that, I will ask one more last question. All right. Now this question is by Paul Henry Moll. So Paul Henry Moore asks, have you backtested your strategy on other instruments such as crypto or forex?
So not yet, because it was just educational project, but I think the concepts of this project is, I mean, online learning, relative pricing could be used for very various set of assets and financial instruments.
Okay. There is another interesting question I would like to pick. So one more. This one is by Mikhail Volodin. So he asks, what about trading derivatives instead of stocks? Are futures easier to forecast using machine learning?
So I think it's it depends on the model, and I think what is the difference between stocks and futures? There are stocks are much more stocks than futures instruments. Probably some futures more liquid than concrete stocks, but the principles I think I do believe the same. You can find futures which are highly correlated with which one you want to predict and use them as create some features on it and use some models. So I would also recommend them to keep it simple, to use simple approaches, to avoid overfitting of machine learning. Many machine learning models tend to overfitting, and it's very important to control this.
All right, so that's about it, I guess. So all the questions. Thank you so much for this amazing presentation and answering so many of these questions, Evgeny. So we will move on to the next presentation now. So this next project is about dynamic asset allocation using neural networks. All right, now the speaker for this presentation is Mrinal Mahajan, who is a risk consultant from India. Mrinal Mahajan is a consultant with a diverse set of experience in portfolio management, fraud modeling, and custom analytics projects. He has worked with some of the major consultancies and financial institutions for the last 4 years. Mrinal graduated from IIT Kanpur and have a FRM certification from GARP Guard, and he is also an alumnus of EPAT by QuantInsti. So I would like to welcome our next speaker, Mrinal Mahajan. And welcome, Mrinal. Are you here with us?
Hi, Kshetaj. Thanks for the kind words. Let me share my screen. Just let me know if I'm able to see the screen.
Yes, we can see. And before we start, Mrinal, I would like to just tell everyone that we are still getting a lot of questions on Evgeny's presentation. So please note one thing, that once this webinar is over, you will get a survey form. You can ask all the questions that you have related to presentation or any other Quantra or QuantInsti courses over there. And we will make sure that all your questions and doubts are addressed after the webinar. All right. So we will try to pick as many questions as possible, but considering the limited time we have at our hand, we will try to select some of the most relevant ones, and we'll connect with you and do make sure that if your question is not answered during the presentation or this session, that you are asking that questions in the survey section at the end. All right. Okay. So moving ahead, Mrinal, over to you. Thank you.
Yeah, thanks, 𝗍𝗲𝗃. Hello, very good evening, everyone. So today I will be presenting my project on dynamic asset allocation using neural networks. So my motivation to build up this project was to actually develop an automated dynamic system for buy today, sell tomorrow strategy, or particularly on the banking stocks, something which would require very less manual intervention. And in order, the purpose to make it dynamic was that it should reflect the day-to-day changes going on in the banking domain and in the market particularly. Other than that, it basically builds up a foundation for further research into this particular domain. Moving on. So the solution basically comprises of three parts. The first part is the model development. Second part being the strategy, and the third part being the risk management. So in the model development part, basically what we're trying to do is that using the neural network model, we are developing a set of three models, one being the probabilistic model, which would predict that whether the price of a particular stock would rise or not, the probability of price rising. And then there are two return-based models. So one of them is the positive return model and the other one is the negative return model. So as the name suggests, the positive return model is basically trained on just the positive return instances and would give an extent to which the price could rise. And similarly, the negative return model is just trained on the negative return instances and would give the extent to which the price of the stock might fall. Then coming up next to the strategy, so basically combining these the output from these three models, we would be arriving at an expected return for the stock, and further dividing it by the volatility of returns for the last 20 sessions. We will try to get a ratio using which we will try to distribute our funds into the respective stocks that we want to trade in. And third, the risk management part, which includes certain issues regarding the transaction cost and automation, which we will cover up later over here. So just a bit more detail on the model development. So as I've already explained, there are two sets of models: the probability model and return models. The data that we have used over here, so the development data comprises of 5 years, 5 years data for the 12 Nifty bank stocks. So and the validation data that we have used over here is from January 2016 to April 2018. And finally, the out of time data that we used in order to further validate our returns is from May 2018 to December 2020. As is pretty common, we have done an analysis and reduction for many of the input variables. Some of them are like the correlation with the market returns for the stocks, and the various several market indicators. And at the end, we have built up a linear deep learning model with convergent architecture. Now, for those of you who are a bit familiar with the deep learning models, so a deep learning model basically would consist of 3 layers. The first one would be an input layer, and the last one is going to be an output layer, and the remaining ones between the two are the hidden layers. So the thing about the convergent architecture is that as we move forward from the input layers, the number of nodes at each of the hidden layers would get reduced. So let's say that we started with around 10 input variables. So we have got 10 nodes at the input layer. At the next hidden layer, it's going to be 5 nodes. Then at the other next, it would be 2. And then finally, there would be one one node at the output layer. So both the models, be it the probabilistic model or the return model, are built using the convergent architecture. So let me explain a bit in a bit detail about the strategy, risk management, and the challenges. So for the strategy, as I've explained before, that we calculated the expected returns from the probabilistic and return models for each stock. Then we divided the expected return with the return volatility observed for stock in last 20 trading sessions to get a ratio. Let's call it S for the time being. Next, we distribute all our available cash in proportion of the positive S ratios. So let's say we want to, we got a certain set of stocks which have positive S ratio. So we will distribute all our funds in the S ratios for those stocks and would buy the respective quantities that could be bought within the funds allocated to those stocks. Then for the stocks which have got negative S ratios, which means that their returns are predicted to be negative, we sell the quantities of those stocks in proportion of the expected losses to their current portfolio value. And for the next session, we update our model using whatever being the results in the current session for which the strategy was implemented. So in this way, this model becomes dynamic, that each day the model gets retrained and you get a completely new linear equation for each of the probabilistics and the return models. In terms of risk management, so here, instead of applying a pure buy today, sell tomorrow strategy, we considered selling our stocks only when we have received them. So this reduces our transaction cost a lot. So instead of squaring off the position, we always sell the stock only when it becomes a holding, only when it's delivered into the demat account. Then we have also applied a stop loss on the stocks. So whenever any stock in a portfolio reaches a certain stop loss, we completely sell it off and remove it from the portfolio. The challenges that appeared over here is, automation of this model updating process utilizing a cloud platform. So earlier we were doing it at a manual basis on a daily level, like we have to run the code after every after the market session ends. And another thing was that it lacks currently a market microstructure strategy in order to suggest a best price for a buy or sell. So currently the orders that we leverage with this strategy are the aftermarket limit orders instead of giving a real-time sort of orders. Now, for those of you who are interested in the mathematical explanation for how this S ratio is derived, so basically you will get a probability P for the price increase from the probability model, and from the positive and negative return models, you will get the log gain and the log loss. So why have we considered the log returns instead of percentage returns? It's basically because the log returns are much more stationary as compared to the fractional returns. And then we calculate our expected returns as the probability into here with the exponential of g minus 1, we are converting our log returns into percentage. So we get our this R is basically the expected percentage return for the stock. So if we, let's say, buy the stock at the end of the session, what is its expected return by the next session's end? And then we calculate this ratio called S, which is simply again the log return, expected log return divided by the last 20 days log return volatility. So here we have hypertuned this to be 20 days. We tried certain combinations 5, 10, and we came out that 20 was coming out to be the most appropriate considering the backtest results. As of next steps, there are a few things in the pipeline. So we are trying to integrate the textual news score for the banking stocks into this model. And then there's a further automation required for conversion for its conversion into an Android app-based solution. One thing that we have probably integrated as of manually right now is the fundamental analysis in order to account for certain red flags for the stocks. For more detail on this project, you can go to the link over QuantInsti, and feel free to reach out to me via LinkedIn. Thank you.
Thank you for taking us through your project work. And I think I would like to again request everyone to start asking their questions in the questions panel. And meanwhile, we already have a few questions. But again, I would again remind that this webinar recording will be available, and both PPT files will be also available after this webinar. And in case any of your questions are not answered, make sure that you mention those questions at the end of the webinar in the survey. Okay, so right now, so moving on ahead with the questions. So this question, all right, so first question is by again Manogan. So this question is, beyond the volatility adjusted fund allocation that your strategy uses, are there any other allocation methods you have tried? I think yeah.
Yeah, so definitely we have tried the simple return-based allocation as well. However, we found out that that volatility one is somehow more appropriate because it takes into account the risk factor as well.
Okay. The next question is by Paul Henry. He asks, what does BTST mean?
So BTST means buy today, sell tomorrow. So basically, the way this strategy works is that you try to buy a stock or try to buy a stock considering that it would, by next day till next day it will give you some returns, and then you would say sell it and get away with it. So that's a very a lucrative strategy, lucrative I would say facility provided by many of the brokers.
Okay. All right. And this next, so the same question is asked by two gentlemen. So one is by Barry and one is by Puneet. They ask, what are the backtesting results? How can you tell them about this?
Okay, so the backtesting returns have been pretty decent. So for the backtest period, the out of time period, we were seeing around 5% returns overall. You can see the same in the blog that has been shared, and the beta testing for this particular project has given us a return of close to somewhere around 10% in the past 6 months.
Okay. Shall we move to the next question?
Yeah, sure. I hope that answers the question.
Okay. All right. So this question is by Bruno about the stop loss. Did you use the
Mhm.
variability of close prices or consider a limited target based on volatility of minimum and maximum distribution?
Okay, so here I didn't really use much of a complicated sort of a stop loss. I simply applied the stop loss of 5% of the portfolio value, the investment value basically on a stock. So whenever, let's say, a stock loses 5% of the value of what is invested into it, it's completely removed from the portfolio. So 5% is
All
the
right.
maximum loss that any stock sees.
Okay. Okay. I hope that answers your question, Bruno. The next question is by again Barry. So Barry asks, does the dynamic asset allocation perform better than simple buy and hold?
Yes, so we actually have benchmarked this against not really the simple buy and hold, but we have benchmarked it against the Nifty Bank Index, and it performs reasonably well than the Nifty Bank. It's close to 5%, somewhere around 3 to 4% than the Nifty Bank Index.
Okay. All right. Uh, Before we go ahead to the next question, uh, everyone, please make sure that you ask all the questions that you have. We will try to answer as many questions as possible during the session. And You can also reach out to us at contact@QuantInsti.com if your questions are not answered, or you can, when you receive the recording of this webinar, you can also make your questions, so add your questions in the comment section of that YouTube video. So we will make sure that your questions are addressed. All right. So moving to the next question, and that is by Bruno. So this question is, did you use the hyper parent tuning for neural network? I'm also going to copy pasting this one in the chat.
Okay, so here we didn't really applied any sort of hyperparameter tuning for the neural network. So we defined this architecture beforehand that we are going to follow the convergent sort of architecture, and all the functions over here, the activation functions are linear itself. The reason for that is that we are at the end of this model, we are going to get an output as a linear equation, which is explainable to us as well, and even to someone as a client who would like to invest in this particular strategy. So in order to keep things simple, we haven't really hyper-tuned any of the parameters. It's a simple convergent architecture with the linear activation functions in each node, except for
I
obviously the probabilistic model where the output at the end has a sigmoid activation.
All right. I hope, Bruno, that answers your question. The next question is about EPAT. So, can you tell us, like, why did you pick this specific topic for the project?
Okay, so I guess for me, I was trying to explore something around which could combine deep learning as and trading together. And before with my studies with EPAT, I was I have been into machine learning for quite a while now. So in order, I believe, and why the banking stocks in particular is because that the prices of the banking stocks more or less do reflect what's their inherent underlying condition is. So those are very much, the market reflects the condition of the banks quite ideally. So that's why I believe I decided to go with the banking sector, and in order to combine the deep learning with the trading, I choose to make a project on this. I hope this answers your question.
Wonderful. So I hope that answers the question. All right. The next one is about your experience with EPAT. So basically, how it. How did so basically you already have this background, and how did it help you upskill in terms of with the project or your overall experience? How has been the overall experience with EPAT?
I guess my experience with EPAT has been very fruitful, not just in terms of learning the trading theories, but also implementing them practically. It gives me a sense around how does really let's say a derivative like an option futures are priced, and that somehow aligned, being from a mathematical background, that is really aligned with what I was looking for. So yeah, I guess it has really helped me to grow as a trader and as a professional.
Okay. And the next question is so I have parked all the questions related to EPAT and Contra for the end. So the next question is about how has been basically uh, the support, the program support. Would you like to share anything about the EPAT support and how was your experience along with because in EPAT you get a dedicated support manager. So if you could share your experience on that front.
Yeah, so I guess that's one of the very good thing about EPAT, that all of your progress is being monitored. So there is someone keeping a check on your progress and pushing you to perform better. So with me, I was given a performance manager, I would say, and there were regular checks around if I'm able to understand the lectures and is there anything that's being a bit difficult. So I believe in that sense, it's very much like of an experience of like being back to college, but again in a in a very supportive kind of an environment.
Related to that, this one is about did you find EPAT difficult considering you are a working professional?
I guess yes. I won't say difficult, but I would say a bit challenging, because I was very new to all the trading terminologies as such, and it took me a while to get a hang of it. Though I had done FRM, but that just gave me a sort of a very basic sort of an understanding. However, as we progressed into the into the course, the things do get a little bit challenging, and I believe that's how the course should be. Has it not been challenging, I don't think I would have pursued it pursued it that much.
That sounds amazing. All right. So I think we are running out of time, and there are still a lot of questions which we did not pick. But yes, as I will again repeat, you have that opportunity. Just make sure that you ask all your questions in the survey panel, and we will answer them uh, as soon as possible from our side. And before we conclude, I would like to hear from both of you, right? So, do you guys want to share anything, like any words of wisdom for aspiring quant traders? So, first, if you could answer this, Munal, and then we can get an answer from Evgeny.
Okay, so I guess I'm very new to the field as such, but for the aspiring candidates, what I can say is that just don't shy away from trying out new things. Just not limit yourself to what your strengths are right now. Uh, Feel free to explore. Feel free to move into new segments altogether, move into stocks, derivatives, and just keep on trying. Don't give up on it, and somewhere down the line you will get a hang of how these things operate.
Wow, thanks for such a wonderful advice. Evgeny, you want to answer that question?
Yeah, I would recommend to be real trading and practice focused. What do I mean? So try to apply what you are learning in real life as fast as possible, because the practical knowledge which applied to practice is much more valuable than just theoretical knowledge. So EPAT course is very useful in terms of practical knowledge also, but try to use it in your probably everyday trading, everyday experiments with trading, and it will help you to grow.
Wow, the more you implement, the more you learn. So that's the message by Evgeny.
Yeah.
Wonderful, wonderful. So thank you to both of you taking out your time and joining us today in this webinar, sharing your project work and answering all of these questions for us. Thank you so much. And to the audience, I would like to say thank you for continuously supporting us through attending these webinars and joining in and motivating us to do more such work in the quantitative and algorithmic education domain. So we would love to go ahead and come up with more such webinars. And in case if you have any topics in mind that you would want us to cover in our upcoming webinars, please make sure that you share those topics in the survey at the end of this session. And till then, I would like to thank again and see you soon. Have a great day ahead, everyone. Thank you, Mrinal. Thank you, Evgeny.
Thanks, Kshitij. Thanks, Akbar.
Thank you. Cheers.